When a lucrative off-market property surfaces, the clock starts ticking immediately. Securing an asset before the competition requires extreme execution speed. Sellers rarely wait, and hesitation usually means losing the deal to a faster buyer. Traditional banking institutions routinely cripple this required speed. A standard commercial or investment mortgage demands anywhere from 30 to 60 days just to reach the closing table, completely out of sync with the pace of active real estate markets. That multi-month delay is driven by exhaustive documentation requirements. Conventional lenders halt the process to scrutinize your personal financial history, demanding stacks of W-2s, years of tax returns, and a pristine personal credit profile before releasing a single dollar. This diagram plots lenders based on two critical metrics: approval friction on the vertical axis and closing speed on the horizontal. Traditional banks sit squarely in the quadrant of high friction and slow speed, demanding heavy paperwork while delivering sluggish results. If an investor identifies a highly profitable fix and flip, but the seller walks away on day 25 waiting for a bank committee to approve a tax return, the investor pays the ultimate hidden cost of traditional financing, a completely missed opportunity. This bottleneck created the need for the private direct lender. These are independent financial institutions operating with their own private capital, completely decoupled from Wall Street's fluctuating regulations and rigid underwriting algorithms. Based in New York, Malve Capital operates under this exact model. They are backed by a diversified capital structure, combining individual investors, bank credit lines, and private equity funds. Because they control their own balance sheet, they make all lending decisions in-house, guaranteeing certainty of execution. They use an asset-based lending approach. Instead of forensically examining the personal financial history of the borrower, they underwrite the intrinsic profitability and value of the property itself. This comparison matrix directly contrasts Malve against traditional banks. Malve enforces no minimum FICO score requirement. They require 0 W-2s, 0 tax returns, and 0 bank statements. They conduct initial underwriting using soft credit checks that do not impact your credit score. In this ecosystem, borrowers make a deliberate trade-off. You are knowingly exchanging a higher cost of capital for institutional speed, agility, and the complete removal of bureaucratic red tape. Because this capital is designed strictly for business purposes, these private funds are legally barred from being used to purchase your primary residence. They are built specifically for investment strategies. This decision tree maps out specific investment paths, starting with the acquisition and flip strategy. For investors looking to rehab properties, Malve funds up to 90% of the purchase price and covers 100% of the construction costs. For short-term bridge acquisitions, they offer up to 85% loan-to-purchase. Loan-to-purchase, or LTP, is a metric that measures the loan amount against the total purchase price of the property. The competitive advantage here is time. Subject to clear title, Malve can close these loans in as little as 5 business days. That speed carries explicit cost parameters. Baseline interest rates in the private sector are higher, with Malve's rates starting at 9%, alongside transparent origination fees typically sitting between 1% and 2%. However, Malve includes a crucial borrower-friendly term. They charge absolutely no prepayment penalties on their short-term loans. If you finish a rehab and sell the property in 4 months, you exit the debt immediately without paying extra fees. The inherent danger in this model is construction delays. If poor contractor management pushes a 4-month project into a 14-month project, those higher private interest rates will aggressively erode your final profit margins. Short-term private loans explicitly reward brutal efficiency and fast execution, while heavily punishing any stagnation in the process. Transitioning to a long-term buy-and-hold strategy introduces a different roadblock. Eventually, acquiring multiple rental properties causes an investor's personal debt-to-income ratio to max out conventional bank limits. Debt-to-income, or DTI, is a personal finance metric comparing your total monthly debt payments to your gross monthly income. To bypass personal income limitations entirely, investors use the 30-year DSCR loan. DSCR stands for Debt Service Coverage Ratio, a metric used to evaluate a property's ability to cover its debt payments using its gross rental income. This scale illustrates the core mechanic of the DSCR loan. The loan is approved based exclusively on the property's monthly rental income perfectly covering the monthly debt obligations, achieving a ratio of exactly 1.0. While a 1.0 ratio is the absolute minimum requirement, securing the most competitive interest rates and highest loan-to-value ratios requires a respectable credit score of 660 or higher. Loan-to-value, or LTV, is a ratio that compares the amount of the loan to the appraised market value of the property. Because this calculation ignores your personal W-2 salary, your personal income no longer acts as an artificial ceiling. You can acquire dozens of properties based solely on their individual performance. Provided the underlying real estate produces consistent positive cash flow, DSCR loans transform personal financial limitations into unlimited portfolio scaling potential. The most complex investment scenario involves acquiring raw land and executing a ground-up development project. Malve Capital supports these massive undertakings by providing up to 100% of the required construction costs to get the building off the ground. A development project is inherently sequential. You cannot frame walls until the foundation is cured, illustrating the rigid physical progression of building from the ground. To manage this, Malve uses structured disbursements. Funds are not handed over in a single lump sum. They are released in deliberate draws, only after specific, pre-approved construction milestones are physically completed on site. This specific structure requires rigorous project management. You must have a reliable contractor network to ensure phases are completed on time, so the next round of capital keeps flowing. Ground-up private financing minimizes the amount of personal capital you have trapped in a project, but it demands a ruthless level of operational discipline to execute successfully. Stepping back, the premise of private direct lending is straightforward. The lender intentionally removes bureaucratic friction and delays, and in exchange charges a premium interest rate for that distinct privilege. This scorecard categorizes exactly which real estate strategies match perfectly with premium capital and which strategies do not. You should avoid private lending if you are buying a primary residence, acquiring negative cash flow properties as a novice, or operating on a relaxed 6-month acquisition timeline where speed is irrelevant. The ideal users are aggressive flippers who need to close off-market deals in days, self-employed entrepreneurs locked out of conventional banking due to tax write-offs, and portfolio builders using DSCR to scale without limits. Beyond the numbers, Malve provides a distinct qualitative advantage. Borrowers are assigned a dedicated in-house team member who knows their specific deal intimately, rather than having their communication outsourced to disconnected automated call centers. It represents the abrupt removal of bureaucratic friction, clearing a direct and unobstructed path for the modern entrepreneur. In real estate, capital is a widely available commodity, but certainty of execution and the speed to act when an opportunity strikes are the true competitive advantages that build a modern portfolio.